U.S. GDP data came out today, and the advanced estimates showed that the U.S. third quarter GDP grew at 2.2% exactly, which is lower than the consensus estimate of 2.7. So we'll be discussing global growth, U.S. growth, and some of the major themes that investors should be watching out for right now. Our next guest is Peter Berezin. He is a chief global strategist and director of research at BCA Research. Welcome back to the show, Peter.
Thank you.
Let's start with U.S. GDP first, and we'll talk about monetary policy around the world. So, like I explained earlier, lower the consensus estimates. Were you surprised at this?
Well, the headline number itself was lower than expected, but I would say that the internals were not that bad. Much of the weakness in third quarter GDP reflected very, very weak performance in the auto sector. If you look at purchases of vehicles, they were down over 50% quarter over quarter annualized in the third quarter. And that largely reflects all the problems that we have heard so much about in getting enough semiconductors into cars. That one sector, and it's only like 4% of consumption in most years, that one sector of the auto sector subtracted 2.4 percentage points from overall GDP growth. And that dragged down the headline number. If you look at services, for example, service spending was up around 7%. In fact, a little bit more than 7% in the third quarter, which is pretty good considering that the peak of the Delta variant wave occurred in Q3. So I think what we're going to have is a much better performance in growth in the fourth quarter and into next year.
Okay. Some would say that due to the base effects, it was expected that GDP growth would be lower anyway, right?
That's right. I don't think it really caught anybody by surprise. I mean, if you look at payroll growth in Q3, it averaged around 500,000 per month. Like normally when you get that sort of payroll growth, you would get growth rates in GDP of like 5-6%. So certainly the other indicators that people track to gauge the overall health of the economy are still pointing to an economy that may be slowing, but slowing from very high levels, and one where growth is going to remain above trend for the foreseeable future.
Let's tie this into the broad equity markets now. The S&P 500 certainly didn't react negatively to the news. In fact, it went up today, a few percentage points. So, what's your view on the stock market in the U.S. right now? I know you were bullish before last time we talked, and you were right. The stock markets have continued to grind higher. Have you changed your view since, or are you maintaining that stance?
Well, I think we're in an inflection phase where good news on growth will not necessarily be good news for the stock market, because the stock market is concerned about stagflation. They're concerned about overheating. They don't want the Fed to raise rates more than the sort of gingerly path that the market is currently discounting. So from that perspective, the fact that growth fell shy of estimates was not a big deal for the stock market. In fact, bond yields came down a little bit, which I think is reassuring for a lot of investors.
I want to talk about stagflation in just a bit, but first, for an investor who maybe not yet invested in the markets right now, would you advise them to get in right now and put money in, let's say, the SPY, or maybe is the risk-return profile right now not worth it for you?
Well, I think it's still better to have your money in stocks than in a bank deposit where you're guaranteed to lose money after inflation. So the siren call of Tina, there's no alternative to equities. I think that is going to continue to resonate with investors for the foreseeable future. Having said that, stocks are not cheap, particularly in the US. And so I think if investors want exposure to equities, it might make sense to look abroad. The S&P 500 is trading at around 22 times forward earnings. Stock markets outside the US are trading at 15 times forward earnings. So non-US stocks certainly are more cheaply priced than their US counterparts.
Mm-hmm. And so given that outlook, what are the best asset classes you think have the most growth potential into 2022 and beyond?
Well, I think within the stock markets, we're moving into a phase where a lot of the sectors and styles that didn't do well over the last 18 months may start to do better. So I think value stocks in particular, they're very cheap. They're about 3 standard deviations cheap compared to growth stocks based on historic measures of price to earnings, price to book, dividend yields. Growth stocks are dominated by tech. Tech, of course, benefited from the pandemic. People had to stay at home, so they shopped more on Amazon. They had to buy a new computer, for example. But as we get into a more normal economic environment, the theme will not be the pandemic. The theme for investors will be reopening. And I think that would tend to benefit value names. And I would say, in particular, banks are quite attractive at the current juncture. I think we've hit a secular low for bond yields. I think bond yields are going to be rising for the next few years at least. And historically, banks do best when bond yields are going up, and that is the environment in which we find ourselves.
Okay, and let's talk about stagflation now. I've spoken to some analysts who have speculated that the current stagflationary or the upcoming potential stagflationary environment could be as bad as the 1970s. Is that possible?
It's possible, but I wouldn't bet on it being that bad. I think the Fed would try to cool down the economy by raising rates before we got to double-digit inflation. But having said that, I think the risk to inflation is on the upside. And I think inflation will probably follow a 2 steps up, 1 step down trajectory of higher highs and higher lows. Right now, we're probably at the top of those 2 steps. Mm-hmm. So the next step for inflation will be to the downside because a lot of the inflation that we see today is concentrated in durable goods. Durable goods is actually the one category of the CPI index where prices usually fall over time. So this is not a sustained source of inflation. To get inflation to stay up, you need rapid wage growth. The labor market is certainly heating up, but most of the wage growth so far has been at the bottom end of the income distribution. I think we probably need to see the unemployment rate fall more before we get a true price-wage spiral. So in the near term, I'm not too worried about inflation. In the longer term, I think it is more of a concern.
Well, I know you said that it is still better for an investor to hold onto stocks than cash in a bank deposit. But investors might be wondering, Peter, well, given that we may enter a stagflationary environment, don't you think asset classes could potentially correct or crash? How do stocks, for example, usually perform during a stagflationary environment?
Well, first of all, I don't think we're in a stagflationary environment. When you think about stagflation, you think about sort of the misery index, right, where you have rising inflation and rising unemployment. We've got moderately high inflation, and we've got falling unemployment. So we're not in a stagflationary regime yet. At some point, we might be, but I think before we get there, we're going to have above trend growth for a while and falling unemployment. And in and of itself, inflation is not bad for stocks. Mm-hmm. Inflation is only bad for stocks if it leads central banks to hike rates. I think the Fed right now and most central banks are quite reluctant to raise rates aggressively because they think that the balance of risks is still tilted towards deflation rather than inflation. So we might need to see quite a lot of overheating before we experience a lot of monetary tightening.
Well, let's talk about central banks then. The ECB this week has kept rates unchanged. Now, investors are wondering which central bank around the world is most likely to begin liftoff first. What do you think?
Well, certainly there have been a few central banks that have already started the process of normalizing interest rates. So Norway, New Zealand, I think Canada is probably going to go soon. Amongst the largest central banks, the Fed will probably move first to raise rates, most likely late next year. But even when the Fed starts raising rates, it's not going to do it very quickly, nor does it plan to raise rates very high. The Fed's view is that the neutral rate of interest, the interest rate consistent with full employment and stable inflation, is probably around 2.5%. So from the Fed's perspective, monetary policy now actually isn't hyper stimulative. And from the perspective of the ECB or the Bank of Japan, their view of where the neutral rate is even lower. So I think they're going to be even more reluctant to raise rates prematurely.
Well, you're right. Fed Chair Jerome Powell has stated that we need full employment as a condition before liftoff. So are you implying then, Peter, that we will reach full employment by the end of next year?
Oh, I think that's probably right. We might be close to full employment now, although clearly the labor market is still experiencing a lot of dislocation from the pandemic. Probably by the end of next year, we will be approaching full employment, and the Fed will start raising rates. But again, because the Fed thinks that neutral is quite low, it can't afford to wait and only raise rates gingerly.
Okay, well, let's talk about the next step in the business cycle. Obviously, we just came out of a recession. If the Fed were to raise rates late next year, like you stated, would that not cause a contraction in the economy? Would that cause the next recession very soon?
Well, it depends on where you think neutral is for interest rates. My sense is that the neutral rate is actually higher than where the Fed thinks it is, which means that monetary now is probably more stimulative than the Fed realizes. And the reason I say that is, one, I think fiscal policy is going to be more expansionary in the post-pandemic period than it was prior to the pandemic. Now, the IMF came out with some projections just a few weeks ago, and they expect budget deficits in the U.S. to be about 3% of GDP larger between 2022 and 2026 compared to the years prior to the pandemic. So fiscal policy is going to be more expansionary. That means more demand going into the economy. That in turn means a higher equilibrium rate of interest. We've had a big wealth effect from rising asset prices. It's incredible. In fact, if you look at the numbers, U.S. household net worth increased by over 100% of GDP between the fourth quarter of 2019 and the second quarter of 2022. People feel wealthier. When they feel wealthier, they're going to spend more. When they spend more demand in the economy, a higher equilibrium rate. So I think it's going to take actually quite a lot of tightening to bring this economy into recession, which is why I'm not worried about a recession anytime soon.
So, of course, the question that investors are wondering is how far the Fed can go in their rate hikes. I've heard the argument that, let's suppose they go up to 5%. That would imply an interest expense of $1.5 trillion on $30 trillion of debt, which is more than what the Treasury could afford to pay on an annual basis. So what do you think is the absolute ceiling for a rate hike?
Well, sure. There's going to be feedback loops from higher rates into the economy. Higher rates will not only make it more expensive for governments to finance debt, they'll also probably put downward pressure on asset prices. And if asset prices fall, you're going to have less spending and less need for higher rates. So I don't think the Fed can raise rates to 5 or 6%. But the market's not expecting that. The market is expecting the Fed to raise rates to only 2%. I can see the Fed having to raise rates to maybe 3%, 4%, which is above market expectations. What will become interesting down the road is what the government does in terms of political pressure on the Fed to keep rates low. Because as you said quite correctly, David, there's a lot of debt the governments have taken out during the pandemic. They don't want to have to shift resources from social programs to pay off bondholders. So we could see political pressure on governments. We could see political pressure from governments on central banks to keep interest rates down. And that ultimately could cause inflation to rise, leading to some of that debt to be ultimately monetized.
So we've been living in a zero rate environment for a very long time, Peter, probably the most in history. And now we're just coming out of that environment. Well, we will be eventually. What do you think is going to happen to investors' mindset? Do you think there will be a massive capital reallocation following this move to higher rates that we haven't seen in many, many years?
Well, I think at some point there will be a lot of turmoil. I think at some point the Fed will realize that it's behind the curve, that it really has to ramp up the pace of rate hikes. When that happens, you don't want to be anywhere near the stock market. You don't want to be in the bond market either, and because you're going to have bond yields rising and stocks falling. It will be at that point more of a stagflationary environment. But I think before we get there, we're going to have to see quite a lot of overheating. I mean, it's quite instructive just to look at history, and in particular what happened during the 1960s. Unemployment was back towards NAIRU, like full employment in 1962. It really wasn't until 1966, when the unemployment rate was 2 points below NAIRU, that inflation started to gallop higher. So it does take a while often for economies to overheat. I think we're still in the early phases of that process. So for now, I would be encouraging investors to remain overweight, but at the same time to be vigilant. If inflation expectations were to break out to the upside, they haven't yet, but they could, then at that point, I think you need to get a lot more worried.
You brought up, but this is an important concept. Can you please explain the concept of NAIRU to the audience, and where are we currently? We're not near NAIRU right now, are we?
Yeah, well, NAIRU is a fancy term for the unemployment rate that's consistent with full employment, where everyone who wants a job can get a job. We don't know where NAIRU is now because the pandemic has led to all sorts of changes in behavior. A lot of people retired early. Some people are reluctant to enter the labor force because they don't want to be exposed to the virus, or they don't want to be vaccinated, et cetera, et cetera. So right now, it's a bit of a mystery actually where full employment is. My guess is that as we get into next year and things settle down a little bit, we're going to have more people joining the labor market, and that'll help keep wage growth from rising to such a level that a price wage spiral emerges. But I have to say there are risks around that view, and I think the risks are tilted towards higher inflation rather than lower inflation.
Yes, and you mentioned earlier that should the Fed realize that they're behind the curve, they need to catch up. There could be turmoil in the markets. You don't want to be anywhere near the bond markets. You don't want to be anywhere near the stock markets. Where would you go in that case? In that particular scenario you've described, I'm going to guess you're not going to say Bitcoin. So where else?
Well, Bitcoin's a risky hedge against inflation. I think there are safer hedges, and it's not just gold. I think property, real estate in general, is a good hedge. If you think about what asset class did best in the 1970s, it was farmland. So yes. Go buy yourself a little farm, and if you're worried about stagflation, you'll be able to hedge that risk to some extent.
Okay, excellent. Peter, I want to thank you so much for being on the show today. Excellent thoughts as always.
My pleasure.
And thank you for watching Kitco News. I'm David Lin.